Hi there, this is Helen Tarrant again from here with our whole team. Wow, it's massive. Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and I'm going to share with you what happens when the interest rate rises when you are in a commercial property. Now, there's a lot of talk out there and lots of people asking me, I don't want to get into commercial property right now because the interest rate is going to go up. I'm worried that, interest rate, if it goes up to 5%, then the market is going to tank. And if it goes to 5%, then I'm going to be negative territory with a commercial property. Well, yes, if you're buying 4% right now, then yes, absolutely, when it goes to 5%, you'll be negative. Or you might break even because, rental increases will bring it up, and you might be just and breaking even, or you might be slightly negative. But if you're buying 5% or 6% or above, then you're absolutely not going to be negative. Now, why is it right now that's so important for you to get into commercial property? It's because, you see, the market is, right now, we are at potentially somewhere like a Brisbane, Gold Coast, Metro. In Sunshine Coast, we're about 5 to 6% in Metro. And when you're 5 to 6% metro and your interest rate's at 2.5% to 3% right now, you are still making a margin. You're making a margin anywhere from 2.5% to 3.5%. Now, don't forget there's rental increases every year. So if you start out at $50,000, let's say start out at $50,000, next year CPI and inflation at the moment, based on last quarter, was about 5%. But let's say going forward, it'd be probably conservative around 3%, maybe even going to 4%, but 3% is pretty conservative. And if you look at 3%, you're probably thinking, okay, well, your $50,000 property, the $50,000 net rent becomes $51,000, 50 miscellaneous the next year, and then the next year it compounds and compounds. Now, your interest will start creeping up, but it won't be 5% straight away. What it will be, it might take 2 to 3 years for it to be 5%, and that's if we're accelerating really, really fast and we're having huge inflation in this market. And just imagine paying 5% for your residential mortgage, because if you're paying 5% for your commercial mortgage, you're paying very close to 5% in your residential mortgage. Right now, when you look at how much residential mortgage is and how much commercial mortgage is, they're really on par. They're probably about 0.5% to at most 1% difference, depending if you're buying an investor loan or owner-occupier loan in the residential space, or whether you're buying an owner-occupier loan in the commercial or investor loan in the commercial space. Now, that means that when commercial property interest rates are at 5%, you are going to be at 4 or 4.5% for residential rates. Imagine what's going to happen in the market, right? There's people there with multi-million-dollar mortgages on their own home. The average home in Australia and Sydney right now is probably at least $2 million for a decent suburb with a decent house, right? Most people are maybe borrowing anywhere from 60 to 80% of that. So they're well over $1 million. They're probably somewhere around $1.5 million in debt on their own home, let alone all of their residential investment properties. Now, if it goes up by 2% or 2.5%, most people are going to be in the red, struggling to keep their own houses. So that's going to create a bit of a panic in the market, and residential property prices will drop. Now, on-flowing affects that to the commercial property, and that's why I talk about the residential, is that the ongoing effect on the commercial property is that there will be this push for people to now want some kind of incentives from the vendor to help them, because they're going to find that their wages or that what they're charging, their services, are not going to be enough to cover their mortgages. So they're going to be wanting some kind of incentive from the commercial space. But if you're also a landlord and you are now getting 5% as interest rate rather than 3%, you've also had time in the market. And having time in the market is so important when interest rates are about to go up. Because when you have time in the market, it allows for those rental increases to create a buffer and insulate you against what happens when the interest rate increase happens. So if you get 3% rental increases each year, and you continue on for, might be holding the property for 2 or 3 years before we go to 5% interest rate, or 5 years, you're now actually getting somewhere around 7% return for your property, 7% yield, because over time the growth. And that means when interest rate is at 5%, you're still clearing that 2% buffer. Now, if you look at historically what's happened in the commercial property space, and for most of you, you probably haven't experienced that if you're first-time investors right now. But historically, if you look at what's been in that space, it has been that commercial property has always cleared anywhere from 2 to 3% of what is on the market in terms of the yield play and the interest rate. Now, back in 2012, when we first bought our first commercial property, the yield in Sydney, and this was in North Sydney, was 8% or close to 8%, which was crazy. But also, back 10 years ago, warehouses in western suburbs were doing 9%. Right now they're like 4% or 3%, right? So then, but at the time in 2012, the interest rate in commercial property was 6%. So in Sydney, we were still making the 2% margin, but the interest rate was 6% and the yield was at 8%. Now, if you go back to a point where now the average return in Sydney in terms of yield for a commercial property is 4%, then now you're getting your interest rate about 2% or 2.5%. So you're still clearing relatively the same margin. Now, if you have time in the market, it would allow you to create more of a buffer, which is why it's so important to really get into commercial property right now, but also to make sure you don't overpay for it. And what we're seeing in the market is those people who are going to auction, and if the property had no upside, they're just clean commercial properties, and they're like, tenants, 3 or 5 year leases, really clean, take care of the outgoings. We're seeing people typically pay 30% above market value for these properties. Now, they're the people who are going to be hurt the most when interest rate goes up, because they've paid above the market for this property. They don't have the insulation that you would get, or the buffer you would get, if you bought in at the right market yield. So there's never been a time where it's so important to buy right now into the right market yield in this market. And a lot of people, there's a lot of traffic and a lot of noise out there, and most people are doing it wrong, are buying the wrong type of properties because they're chasing the hype. Just imagine right now you're going to buy a 5% yielding warehouse property on the Sunshine Coast. Where is that going to go? And if interest rate goes up to 5%, you're neutral at that property, or you might be a little bit above right now. But if you bought a 6% yielding property that's not a warehouse property, potentially a retail or an office space, still with a solid tenant, you're already ahead of the game. If it goes up to 5%, you're creating more buffer for yourself in the future. And that's why it's so important to buy into the right yields and not to get caught up in the hype. So when interest rate goes up, think of 2 things. Number 1, can you create a buffer in your investment right now in the next 3 years to insulate you against the interest rate rise, so you can still receive positive cash flow and a return on your money? That's the deposit you're putting in to the property. Number 2, can your property, in terms of the rent that you're getting from your tenant, sustain an interest rate rise? Meaning that, can your tenant, in the event that there is an interest rate rise, afford to pay the rent that you're charging right now? Or if the tenant leaves, a new incoming tenant can afford to pay that rent, still operate a profitable business, and be able to basically live and sustain themselves through that period. Because interest rate will go up, it'll come down, it'll flatten. So all of those things will happen because it's happened before, right? But you've got to ask yourself about that, because rent is really important. Because the last thing you want is that you bought in at a high price and the rent drops. Then your yield is compressed, and then you're just being negative, right, in the negative territory. And you don't want to be that with a tenanted property in the commercial space, unless you're going to get massive development upside or massive growth in the future. But if you're buying in regional areas, or you're buying in Sunshine or Gold Coast, it's not going to have the same growth as you would in Melbourne or Sydney. So really ask that question. If you're in a metro area, it's a little bit easier to identify whether the rent will continue to grow, because you can see right now that even in office spaces in Sydney and Melbourne, where previously, maybe 6 months ago, we're seeing there's a 30% discount on office space rent and retail space rent in the CBD area and just fringe CBD. Now that's come back. Now maybe people are getting 10% off what it was originally, and by the end of the year, they will be back to pre-pandemic rate and probably 5% higher. So and there'll probably be a little bit of a growth that will happen with the rent, which will push the value back up in terms of office space. And those people who didn't get into office space, I wish they got into office space. But that's another video for another time. But just remember that to look at whether the rent your tenant's paying is able to be sustainable during a period where there's high interest rates, where they're going to have to pay additional money in terms of their own living expenses, in terms of their own investments, in terms of all this. What we're having is a disrupted supply chain where they're paying more for stock, more for materials, and also weight rises, because as people need more money to support their investment, they're going to ask for wage rises. So you're going to see if the rent they pay is sustainable in the long term for a profitable business. And that's really looking at rent comparisons and everything else. And we'll do a separate video on that as well. But look at that. Look at whether you can create by getting into the market at the right yield. So don't get caught up by the shining objects. Getting into the market at the right yield, and then making sure that in the next 3 years, you can create a buffer to insulate yourself against high interest rate rises, so that you can still sustain that level of repayments, plus make positive cash flow on top of that and a return on your investment. These are complicated concepts, right? So take a deep breath. I know I've covered a lot, and you might need to go back and replay that. But these are the things that we look at, and these are the metrics we look at for our clients each and every day. And the reason we do that is because when we think about where our client position is, we want to think about it in the long term. Not that they just got a great property that's going to last them 2 years, but a great property that's going to last them 20 years. Right? And this is why you need us to come and help you build a commercial property portfolio that is really going to sustain the test of time through the up rises of the market, through the flattening and through the downtimes. You want us to be able to guide you and build with you and work in partnership with you to build a long-term commercial property portfolio that's going to give you cash flow and growth together. So if that's what you're looking for someone to help you with strategy, looking for someone who can guide you through, looking for a team to surround you, someone to support you, reach out to me, helentarrant.com, and let's jump on a strategy session. Let's talk and let us help you find your first commercial property, or just build out a portfolio for you if you have one already. So until the next video, tell me if this has been helpful. If you've learned a lot or you want to ask me more questions, post below, show me any topics you want, and I look forward to speaking with you soon. Bye for now.